Hello, this is Keenan with Wall Street Moses, and I want to show you this high return on investment smart money Forex trading strategy because a lot of people want to be able to risk a little bit and make a lot, but they don't really understand the blueprint to doing that. So stay tuned on this video, and I'm going to be showing you exactly how to win using smart money trading strategies. So first aspect of smart money trading strategies is that when people make their trades, this is the simple way of their making their trades here. Say we have a downtrend. The simple way that people are making trades is just waiting for support and resistance to line up. So you got a resistance point there, then you got a resistance point here. And let's say we do another small one here. And you got a resistance point in this area here. Let's fix this. So a lot of people will play the markets expecting that the markets will be this clean like this. And if you know anything about institutional trading, is that they trade in a way to where it induces traders, retail traders, to make moves that they can manipulate and that they can take advantage of. So a lot of the trading education teaches basic traders to trade what's called a break and retest of simple support and resistance levels. Now, if it was that easy, a lot more traders will be winning in trading, but it's not. They show you this diagram every time you look up different courses, and it looks clean. You know, it looks like that's a great plan to work out, and that the markets are just going to give you these easy patterns and this easy predictability on such a simple trading strategy. And the market makers take advantage of it. One way is if you're placing a sell trade, a lot of the times you're going to have a stop loss kind of halfway between the zone. And then you're going to hope to trade from zone to zone. And the issue with this is that the market makers, they know where your stop losses are. And two, a lot of people are doing the same thing. So what's happening is that, if I want to illustrate, let me show you to illustrate it. If people have stop losses, they literally have a bunch of orders. Let's just say that they can see the orders like this. They can see it on a list. They will see the amount of trades that have stop losses at certain price points, because everybody has entries around this level here. But the stop losses are congregating right here. Say there's a little bit of stop losses there, but most of them are in this area. What do you think the market makers are going to do at that point? What they're going to do is take the markets up here. You know, it'll pretend like it's going to respect this level. And then what you seem to notice, and it's probably happened to you, is that after it goes down a little bit and you think you're going to win that trade, it's going to be an easy trade, it shoots up and doesn't even shoot up for long a lot of the times and gets to those levels where most of those stop losses are. And there's a second reason why it gets up to those levels. So the first reason is that you have people that are trading that break and retest there. Then you have also people that trade breakouts, and they're taking a buy position above that zone. They're taking a buy position above that zone, and they are taking it to the next zone here and possibly have a stop loss before the zone that it broke out. So you have the sell traders and the buy traders. And the reason that's important, you would say, well, why would the market makers be looking for people that are buying when they're trying to sell? Because they need buyers. They need enough liquidity or enough buyers to be able to place the level of trades that they want to trade. Because you can agree that there's more orders being done when an institutional trades versus one retail trader. So they need a lot of retail orders in a certain areas to be able to place the order that they want to place. In trading, you must sell when others are buying and buy when others are selling. It's an exchange. It's a trade. You got to remember that. That's the basic component of trading. It's a trade. So if you're trading something, there's an exchange. One side is buying, one side is selling. So another reason that, they look at the sell orders and they go for the stop losses. To get out of a sell, you must buy your position back. That's the fundamental aspect of it. So a stop loss in a sell is actually a buy. So if you can be in an area, if you're an institution where you're trading in an area where there's either a bunch of stop losses or a bunch of buy orders and you want to sell, that's the order you want to place. So if we break this down, if you institutional liquidity targets, that's the word you want to remember, is liquidity or objectives. Liquidity objectives. So number one is target, and we're going to do for sales because we're looking at a sell option. For sales, one is going to target retail sell order stop loss levels. Two, trigger retail buy order common area. And three is to mitigate. I'm going to show you what this is. It's to mitigate previous institutional position. So those are the three things you want to look at when it comes to institutional liquidity objectives. And understanding this is what's going to help you have a high return on investment trading. So the third part is to mitigate previous institutional positions. So let's say, it's not, let's say, that the bigger moves do not happen by retail traders. They don't create these moves, institutions that create these moves. And what happens a lot of time before these moves are created, that there are what's called a small mitigation point. What I mean by that is, say before that big move, you'll see this a lot and I'll show it to you, is you would have like a big move down, you would have maybe a smaller move up. And what that move is doing is recreating this scenario. So this move up happened to capture all of these orders. This move happens to capture the orders of the retail traders. So now that they have enough ammo to place their position, then you see a big candle happen right after that. So what happens a lot of times, let's bring this down actually. So what happens a lot of the time when it comes to these orders is that the institution placed a buy order in order to be able to trigger enough liquidity in the market to be able to place their real order of a sell. And when they place this sell and the market is continuing to go down to whatever level it goes down, of course, it's not going to be all red candles, but it'd be a pretty decisive swing when the market is in play with the market makers and the institutions, is that they leave this buy order open. And so like in a sense, even though they're profiting on their bigger trade, they are in drawdown on their smaller trade, this mitigation trade. And for people who are in drawdown and want to get out of it, what do you hope the market does to get you out of drawdown? To bring you back to break even. So what is break even on this move? It's to open of that candle. That is the break-even point. So what happens when you break even, you close a trade, you're closing a buy trade, you're also selling. So you have this buy trade here, you close it, and the market returns here, and the institutions close that order. That's also a sell. So they have a sell coming from here, and then they probably add to that sell with their own selling trade to move the market back down. This is how you get high ROIs, because a lot of times this candle is not going to be that large. So let's do this real quick so you can have a great understanding of it. So let's say the market did this, right? Market did that. So now if you're placing a trade here, let's get rid of this. If you're placing your sell trade up here, let's say you're trading with the institutions, which is the goal. Normally, what do they teach you? To have your stop loss above the last high. You know, a lot of times it may not be the most recent high, but the last high. And a lot of the times, let's go back to the retail aspect. A lot of times when retail traders trade, they trade using other levels. So a lot of people is taught to use the Fibonacci levels. So let's take some of these extinction points off so we can see it clearly. So they trade these Fibonacci levels. So you got this here. All the common levels. So what a lot of people trade is they don't really trade those deeper retracements. They're taught that the shallow retracements are the best retracements for the bigger moves. The market makers know that. So let's say you take a 50% Fibonacci, you know, going back to trading the retail mindset, and you have your stop loss way up here. But your target effectively is either the next zone or maybe an extension point here. So you have a one-to-one risk reward trade. Or let's say you do understand where to take the entry based off of, you know, institutional trading. You trade somewhere up here, but you don't know the risk management of institutional trading. You have your stop loss above this last high. Well, you're still in that one-to-one territory in trading. Even if you get down here, you have to go all the way out here, and you're still not at 2-to-1 because you have this huge stop loss to cover because of traditional thinking. But here's what it is from an institutional perspective. Your mindset when you're taking your risk management is you're playing off of an institutional playbook. So if you're catching the right trade, then what that means is that the price is not going to go above that institutional candle. It's not going to go above that institutional candle at all. If you're playing by the institutions, because there's no reason for them to let price go above their own move and mess up what they were doing. So with that in mind, you can lower your stop losses. And then, like, say if you're trading at the open of that institutional candle, you can lower your stop loss. Instead of having a 60 pip stop loss almost, you have, say, a 20 pip stop loss. Look at what that does to the risk to reward. You're at instead of having a 1-to-1 or a 1.7-to-1, you have a 4-to-1 going on almost 5-to-1 reward to risk. So for every $1 you're risking, you have the potential of making $5. Being able to make that type of trade over and over again, or set up for that type of trade, is going to give you a higher ROI. You're going to be making money 4 to 5 times faster than with the traditional mindset. So that's what you want to have. So let's look at, now that we have an understanding of this, let's delete that so you can see it. Now that we have an understanding of that, trading with the smart money, let's look at some live examples. Let's go here, look at some live examples. So one last thing to go over. You want to trade, the key is looking for that institutional candle or that last significant move before the opposite real move happens. So this is the last significant buy candle before the real momentum starts. So now that we go into the live market, we look for that. So you see this large leg here. So this large leg right here created what? 300 plus pips of movement. That's a lot of momentum. That's a big move. What if you're looking for the institutional entry of that retracement? What you would gear yourself up for, is looking for that last significant candle before that move started. That last significant bearish candle, because this is a buy move, which would be this candle here. And this is what a lot of people like to call order blocks. So you're looking for that candle here. Some people use just the body. People use the entire body and wick. It's up to your discretion. I kind of like using the body. I'll use the wick if I have to, but I'm 80% just using the body. So now you have a solid area where the markets, they played a small move, and they played a small move before that buy move. So now you're just waiting for the markets to return to that level. And you see it at the open of that candle, that red candle, is where this retracement tapped before continuing this buy move. So if we just focus on this part of the move right here, and we do our risk management idea of a trade position, your stop loss will be below that move, below that institutional candle. So you're looking at about a 20 to 25 pip stop loss. Let's just say 25, just to give it more room. Look at the reward. This is a 5-to-1 trade. It's a 5-to-1 trade off of that move. Now, let's say you took that based off of normal. Let's compare that to normal teaching. So you have your Fibonacci, level, and then you have your support resistance. So this little hesitation right here might have been your entry. So this here, highlight it, it hits a Fibonacci point perfectly. There's some support resistance in the play right there. It took some major momentum to break that originally. So you like that for a retail support resistance level. Let's look at the risk to reward aspect of it. Go down. You have a near, because remember, what most people teach is if you're going to take a retracement, your stop loss should be below the last swing point. So if you're buying, your stop loss should be below the last low. So this is the last low here. So this is the last low right in here, right in this area. That's the last low. So your stop loss has to be below that low. So you're looking at an 80 pip stop loss. Yeah, this was a big move, big retracement, but you're still looking at an 90 pip stop loss. Look at where the market came back to. It came back to this level here. So you have a almost 1-to-1 trade from this. You have to hope that the market at least gets up this high to get 2-to-1. That's a lot for the market to do. So that's your retail version of that trade. You have almost a 1-to-1 that never really materializes. Or you can look for a smaller move. You look for a smaller move, and you have a 5-to-1. You have a smaller move with a smaller stop loss, but you caught less pips, but you have a 5-to-1 reward to risk. Which one would you take? Would you take the smaller amount of pips and make 5 times more? I think I would take that myself. The reason being, because if you're trading risk management, 2% of a 90 pip stop loss is going to be way less of a trade size than 2%, because you're risking 2% of a 25 pip stop loss. That's why you can take less pips and make a lot more, or look for a smaller move and make a lot more, because one, the precision's higher, two, you're risking less, and three, you're able to put a bigger trade size without risk over leveraging. That's why this works. So I hope that this video helped you out, because there's, we can continue. We can even look at one more example before we close it out. You have this little bit of momentum here. So we have this momentum. Let's do one more before we close it out. You have this momentum, and then you have this move right here. So you have that candle there. You see how, let me get rid of this Fibonacci so you can see, and this support and resistance. You see how the market returned to that level, and created its move. The opening of that institutional candle, see right there, is about right there. So market, and then all you're looking for is a stop loss below where that institutional candle happens. If it doesn't, if it touches, gets below where that institutional candle happened, that mitigation candle, institutional candle, whatever you want to call it, order block, if it gets below that, then that wasn't an institutional move, and you take your loss, but you're taking a very small loss. And you're not in drawdown for long. Like you're done with the trade and you keep going. But look at what it does. It's a 90 pip move, but look, another 5-to-1 risk to reward. If you would have held it some more, you could have got it up to being a 7-to-1 risk to reward trade with a 17 pip stop loss. That's the beauty. That's the beauty of smart money trading using high ROI strategies. You know where you're going to trade. And look, let's for kicks here. Another move, because you know where you're going to trade. Another move right here, another momentum move. You look for that last significant bearish candle because it's an up momentum move. And watch, look. The market, this one tested you a little bit, but it never got below that candle. And if we mark this up, if it's a bigger candle, what I like to do is trade 50% of that candle. So instead of doing at the open, I do 50% if it's a little bit bigger, just as a side note. So 50%, my entry would have been here. Stop loss would have been right in here. So we're looking at another 20 pip stop loss. And look at where the market went. The market, if you would have held it, that's almost 10-to-1 risk to reward. But let's say you went for an easy level, that's still another 5-to-1 risk to reward. And you can do this with all types of markets. Crypto works well, indices it works well, other Forex pairs, gold, silver. This pattern happens over and over again. So definitely look at this pattern, consider trading it if you like it. And I hope that this video helps you win and make a lot more money trading. This is Wall Street Moses, and y'all have a great day.